Everybody, it's John King with Summit Funding, and I'm coming to you with my 2023 market update and kind of my forecast on where I think things are going heading into the new year. So join me as I kind of ride through what this is going to look like and what you can expect from the coming year. Clearly, the attorneys want me to say I can't predict the future. Nobody can predict the future. So what I'm talking about really is my feeling of what has happened, what's happening now, and where I think that's going to lead us to where we are going. So let's dive in right now. The first thing I want to talk about is actually recapping the last 2 decades of where things have gone and why we got to where we're at today. So if you rewind all the way back to 2000, we were in the midst of really a growing housing market, a growing economy. .coms were taking off, and we had the .com bubble. And that didn't hurt the housing market. Builders were building, people were buying, and something called household formations was happening at a normal pace. Household formations are when somebody graduates from college, they move out of their parents' home, and they rent an apartment or buy a house. They have formed a household. Household formations is a statistical number that's critical to a lot of where I see things going and where I think the economy is headed and where the housing market is headed. So we ended up fast forwarding to 2005 and 6, and my industry started doing stupid things that they weren't supposed to do, and they gave money to people that they shouldn't have given money to, and those people lost their home. We ended up being in a position where we were qualifying people for mortgages without really qualifying them for a mortgage. And those people couldn't afford their monthly payment. And they were banking on the fact that they were going to be able to refinance in a year or 2 or 3. And it just didn't happen. And so it created a domino effect. What we had was we had sellers that had to sell. That being the bank who foreclosed on the home, or someone who was in a short sale position that had to sell their home. That's what caused the plummeting of the housing prices, is because you had sellers that had to sell and didn't have to buy. And that's a critical thing to remember when I start talking a little bit later about what's happening in today's market, that there's a big difference when we had 2007, 8, and 9 sellers that had to sell and didn't need to buy because they were a bank or they were a homeowner who couldn't qualify for a mortgage anymore, and so they weren't able to buy again. And now what we're in now is a position where we have sellers that need to sell and buy, and I'll explain why that difference is critical. But anyway, we end up 07, 08, 09, 2010. We've got a lot of foreclosures. We've got interest. We have a recession caused by the housing market. That is the only recession where housing prices went down. Every other recession in history, housing prices were higher at the end of the recession than the beginning. And that's critical to remember in a couple minutes when I talk about where I think we're going in 2023. Now, continue to fast forward. 2012 comes along. The market basically hits its bottom. The Fed starts trying to figure out, how do we stimulate the economy again? How do we recover more from all of the issues that we had starting in 2007? And the Fed starts buying mortgage-backed securities. The Fed starts injecting money into the housing market to really get the housing juices moving. Well, that's great, and that helped a lot in lowering interest rates and getting people wanting to buy homes. But what we also had is we had a period of time where builders weren't building. From 2007 until about 2015, builders didn't build, which was great because it matched the fact that buyers weren't buying because they couldn't buy because they lost a home to foreclosure. As we get into the mid-2012, 15, 20, up through 2018 and 19, we had a pretty balanced market. And the big key to that was we had a reduction in the number of buyers wanting to buy, because we had the adulting movement of the millennials saying, you know what, I don't want to be an adult. I don't want to buy my own house. I don't want to rent my own place. And so I'm just going to live at home with mom and dad in the basement. And that meant there wasn't as much demand for homes. And it was fine because homes weren't being built and new households weren't being formed. That changed in 2019. 2018 rates went up to about 4.75. 2019 rates started coming back down. And then in 2020 with COVID, they came down significantly. The federal government injected a whole bunch more money into the housing market to try and stabilize what was going on with COVID. Now, a lot of people worried and are still worried about forbearance. They're worried about the impact of forbearance and people getting a forbearance on their home and how that's impacting their ability to purchase for keeping their home. In other words, let me back up and explain. Forbearance was a tool used in 2020 and 2021 to help people impacted by COVID who couldn't afford to make their mortgage payment. And so those people got a forbearance or postponement of their monthly payment. But as we all know, there's no such thing as free money and it has to come home to roost. So there's a bunch of people that are currently predicting a huge wave of foreclosures. I don't see it happening because the federal government made sure that the forbearance issue didn't become people losing their homes. What the federal government did is they basically said, look, if anybody was in forbearance, we're going to put that money of the payments they skipped at the end of their mortgage. They're not going to have to pay it off until they sell their home. So it kept them in the green. It kept them with the ability. By the way, a lot of people who got forbearance, they ended up paying the money back a month or 2 or 3 later. So a bunch of people took out forbearance because they were afraid of what COVID was going to mean to their ability to earn income and to pay their bills. And here was an opportunity for the government to say, hey, pause, you're paying your mortgage payment, and go ahead and set that money aside for other things. And people did it. And then they realized it wasn't as bad as they thought it was going to be. And a large portion of the people who filed forbearance, they ended up paying the money back. So it was a non-issue. So now we've got 2022, and we have a major issue with inflation that was started in 2020. Inflation, if you don't understand the basics of inflation, go to the grocery store and you'll get it. Inflation is the increase in the cost of something that you're buying. And so it's normal for cost of goods to go up. It's normal for your pay for you to get a pay raise every year. All of that is normal inflation. Inflation is a good thing. As a matter of fact, the federal government says inflation should be around 2% per year. You should get pay raises around 2% per year. It should cost around 2% per year more for the goods and services that you are buying. But we had inflation that was super, super low for the last decade or two. And we never even came close to the 2% target of inflation until 2021 and 2022. 2021, the federal government says, oh, that inflation thing, it's transitory, it's temporary, it's not going to last forever, don't worry about it. And so everybody said, okay, I'm not worried about it. And then they came out last year and they said, ooh, man, that inflation thing, we were wrong. It wasn't so temporary, it wasn't so transition or transitory. It's a real thing, and we got to do something about it. And so they started raising interest rates. And I want to be really clear, the federal government, the Federal Reserve, has 2 jobs and 2 jobs only. Their 2 jobs are to keep inflation low and keep unemployment low. So their job is to keep inflation in check so that prices don't, it's called price stability, so that prices don't skyrocket and go out of control. So that's job number 1, not in any particular order. Job number 2 is to make sure that people are fully employed, that unemployment is kept low. That is what's called dual mandate. Those are the 2 jobs of the Federal Reserve. Now, why do I say that? Because the Federal Reserve is the one that kind of dropped the ball a year ago by saying, yeah, this inflation thing's no big deal, because they're the ones that have the tools to help fight it. They control the federal funds rate, which is the rate that banks are charged to borrow money overnight. That's the only interest rate the federal government controls. So the federal government last year, 2022, said, we got it wrong, sorry, but we kind of screwed up that call, and now we've got to fight inflation. And our number 1 way to fight inflation is to increase interest rates. Now let's stop for a second. Does that make sense? Like, if you think about it, what the government is saying is stuff costs too much, prices have gone up too high, so to fix it, we're going to raise the price of interest, so you have to spend more money paying your credit cards and spend more money. How is that solving inflation? Well, here's how. Because it stops you from charging on the credit card in the first place. It's the dynamic, and I'm going to use the example of buying a car. Okay. When you buy a car and you buy a $25,000 car, you don't write a check for $25,000. You borrow money for $25,000. But the moment that you borrow the money, that $25,000 is immediately injected into the economy. It comes out of thin air. The bank prints the dollars, prints the check for $25,000 that is immediately paid to the dealership. That money is spread out between the manufacturer, between the salesperson, between the dealership owner. Everybody got paid and has all this money sitting around that they can spend. And that extra money they have to spend is what the government's trying to stop. So if they raise the interest rate on car loans, how many people are going to think twice about getting a car? How many people are going to say, you know what, that $25,000 car was going to cost me $500 a month 6 months ago. Today, it's going to cost me $700 a month. Maybe I should keep the car that I have and get it fixed. Maybe I should put a pause on these plans. And so that's what the government has tried to accomplish, and they've done it. They have absolutely done it. They have increased interest rates that really has focused its energy and effort on the housing market. The housing market was the tool the government used to attack inflation by throwing the housing market into recession in 2022. And yes, we've had a slowdown, a pullback. From a recessionary perspective, I'm not talking about housing prices because we haven't seen a huge drop in housing prices, but we have seen a huge pullback in housing activity, which has led to essentially a recession or a drop in the income or revenue created through buying, selling, and refinancing of homes. If I can refinance your home at 3.25%, you're going to spend that money on a whole bunch of stuff. When the rate becomes 6.5%, you're not going to refinance. You're not going to go buy all that stuff. It's going to decrease spending. So the government did an amazing job of using a scalpel, of attacking the housing industry in order to attack inflation. And I believe the signs are there that they have accomplished their job. I believe the story with inflation right now is we've reached the peak and we're starting to come back down. Now, you're going to hear from the Federal Reserve. As a matter of fact, there's been announcements just this week where the Federal Reserve is saying, hey, yeah, inflation's looking good, but we're still going to keep raising interest rates. It's a bit of a lagging result. In other words, they're saying, hey, if we pull back too early in raising interest rates and slow down raising rates too early, then we're not going to solve the problem. I'm going to use a different analogy right now, and I'm going to talk about antibiotics. So we've all been sick. We've all had to take antibiotics. And when you are prescribed antibiotics, you are told take all of the medication until you have finished. Why? Why do they make you take all the medication before it's finished? The answer is simple. Because the medication needs to finish doing its job. And even once you feel better and the symptoms are gone, the infection is not completely gone. So if you don't finish the antibiotics, the infection will come back, and it'll come back worse because now it's resistant to the antibiotics that you were using because it didn't die. Okay, we didn't kill the infection. So therefore, the federal government needs to make sure that even though we feel better, even though inflation is starting to come down, hey, we got to finish our course of antibiotics. We have to make sure that we do not end up like we did in the 1970s and have inflation continue to take off, and then the government kind of fights it, but doesn't actually fight it well enough, and inflation goes up again, and they kind of fight it, but it doesn't fight well enough, and it goes up again. And in the 70s, we ended up with what's called stagflation. Stagflation means that you have a stagnant economy or kind of a recession at the same time as inflation. And that's a huge problem that the government cannot let us repeat. I won't bore you with the details of why. Look it up if you want, stagflation, and why it's a concern. It's interesting if you're a geek like me, but the fact is we don't want to stop the antibiotics until the course of treatment is over. So the government The Federal Reserve is going to continue saying rates have to go up, but they don't control mortgage rates. The Federal Reserve only controls the rate that banks are charged overnight. Now, that rate influences mortgage rates, but it doesn't control mortgage rates. Mortgages are more concerned about where the economy is going. And when we feel as an industry, the mortgage industry and the bond market feels like, hey, the antibiotics are doing their job. And yeah, I know we got another 4 days of treatment in the antibiotics, but the truth is I feel good. And I know that as long as I finish the antibiotics, I'm going to be in great shape. And you start making plans for your trip the next weekend because you know you're going to be in good shape after the treatment's done in 4 days. That is what the mortgage industry has been waiting for. So we saw interest rates go up significantly in 2022, not because the Fed raised their rate, but because the Fed was concerned about inflation and mortgages are afraid of inflation. Because a bank is going to receive interest for the next 30 years based on today's interest rate. And if inflation is really high, then that money that the bank is receiving in interest doesn't go anywhere near as far. Now, we can't force the people that we gave 3% loans to go to a higher interest rate. But what we can do as an industry is we can charge more to the new people who are doing loans. That's why when the Federal Reserve is raising rates, mortgage rates go up coincidentally, but mortgage rates are really going up not because the Fed raised rates, but because inflation is a problem. And right now, the mortgage industry is seeing that inflation is getting under control, that the antibiotics are working, and that the treatment is working. And there's why we saw mortgage rates drop. We were up to 7.25% to 7.5% back in early November. Then we got a report second week of November that told us inflation's a little bit lower than we expected. We get another report the second week of December telling us inflation's a little bit lower than what we expected. I think we're going to see the same thing in January where inflation's going to be a little bit lower than what we're expecting. And that tells the mortgage industry the antibiotics are working. And we have already started lowering interest rates as an industry. So where do I think rates are going in 2023? This is the number one question of why you're listening. This is the toughest thing for me to answer because I don't want to give you any promises, but here we go. We are currently first week of January here sitting at somewhere between 6 and 6.5% depending upon the day. I think in the next 6 months we're going to move squarely into the 5% range, and I think we got a good shot before the end of the year to hit the high 4s. We went from 7.25% to 6.25% in a matter of 60 days. We could easily go from 6.25% to 5.25% in another 60 days. When things turn, they turn quickly. So I don't want to promise that we're going to see a particular interest rate at a particular time, but I think it's a reasonable expectation to see mortgage rates starting with a 4 sometime late this year to maybe early 2024. Super, super exciting. The problem is, what's that really going to mean to me? So let's talk about the housing market and kind of what this means for the housing market. But before I actually get into the housing market, I do want to cover recession a little bit. It's really the next shoe to drop, and a lot of people are afraid of that heading into 2023. So let's be clear what a recession is. A recession means that the entire economy of the United States, when you add together every dollar that is spent for everything, whether it's buying a good, meaning buying a product, or if it's paying for a service, you add up all the dollars that are spent, that creates what's called the gross domestic product, or GDP. The GDP is a number that says this is how much money the economy has generated. We always look to do a little more this year than last year, do a little bit more this quarter than last quarter. So that is GDP growth, or GDP, the gross domestic product, going up. When the economy is shrinking, it means you add up all the dollars of goods and services that are bought and sold, and it's less than last month or last quarter or last year. That is the definition in general of a recession, is when you see the economy shrinking. Now, there's an old rule of thumb that says 2 consecutive quarters of GDP reduction or negative gross domestic product is a recession. Well, that isn't really true. There's a government department that's in charge of making that determination, and there's a whole lot more to it than that. We had 2 consecutive quarters at the beginning of last year, January through March of 2022 and April through June of 2022. Each of those quarters, we had negative gross domestic product, but it wasn't really a recession. Recessions typically come with job loss and with other signs of issues in the economy. And we didn't see that early last year. The only major problem was inflation. But we're likely to head for a recession. With interest rates skyrocketing as much as they have, the whole point of interest rates going up is to get you to not buy that car. But if you don't buy that car, then the dollars that you were going to spend to buy the car aren't added into GDP. We're spending less money. That's literally what they're trying to accomplish to fight inflation, but that's the definition of a recession. Now, a recession means that people are going to lose their jobs because companies are going to cut back. Companies are going to decrease the number of employees that they have because they don't need as many people. But let's be clear, unemployment right now is between 3.5% and 4%. Severe unemployment, you might be at 10, 12, 14% unemployment. That means that 10% of the population that is working today wouldn't be working if unemployment got that high. That's 1 out of 10 people that loses their job. 9 out of 10 people, they still keep their job. So unemployment, recession is a major issue for that 10%. But 90% of the people keep their job. So the sky is not falling if we're heading for a recession. But in recessions, the federal government the Federal Reserve has to worry about their other mandate. The first mandate is inflation. The second mandate is keeping people fully employed. Well, guess what? With a recession, we have job losses, and the government needs to fight against that. So they raise interest rates to kill inflation. They lower interest rates to get jobs, to spark jobs again, because they need people to spend money. They need companies to want to hire and to open a new plant. And so they're lowering interest rates so that it's cheaper for a company to go build that new plant and hire 1,000 people to go work there. So every recession in history, interest rates for mortgages were lower at the end of the recession than the beginning. What does that mean? Well, it means I think we're headed for a recession, and we're likely to be in a recession in 2023, which means that the historical pattern says interest rates will fall during a recession. What's that going to mean for the housing market? Well, before I can talk about what it means for the housing market, let's talk about really what's been happening with housing prices. We had a huge increase in house prices in 2020 and 2021 because money was cheap and everybody wanted to buy a home. And everybody looked at it and said, hey, I can work from home. I want a nicer home to work from. Or I can work remote. I can move further away and work. And so there was a lot of dynamics coming into play. And a lot of the millennials who hadn't formed a household, who had postponed household formation, they jumped back in and said, okay, I'm ready. I'm going to buy a house. So we had a lot of demand. Demand shot up, but supply didn't shoot up because builders had only started building again around 2015, and they started building hot and heavy in 2020, but you can't catch up that quickly. And they had supply chain issues and all of the problems that came along with COVID and China's warehouses and cost of lumber and all of the crazy things that you've been hearing from me and everybody else. So what does that mean? That means that there aren't enough homes for the people that want to buy them. Now, in 2022, that hasn't been a problem. Everybody talks about a foreclosure crisis, about price. Even without foreclosures, a lot of people have said, hey, I expect housing prices to drop significantly because interest rates are way up and therefore buyers aren't going to want to buy. So sellers are going to have to lower their price. There's some truth to that, but not the truth that's going to cause prices to fall out the bottom. Here's why. Because every traditional seller, let me rephrase that, most traditional sellers are also traditional buyers. John, what the heck does all that mean? Simple. In most cases, A home seller is selling their primary residence and they're needing to replace that with a new primary residence. Even if they're an investor, many investors do what's called a 1031 exchange. They sell one investment property and they buy another. So investors, they are replacing one home they're selling with another one that they're buying. So there's not there's no inventory coming from nowhere. We're not going to have prices crash because sellers not only don't have to sell, in a lot of cases, they don't want to sell. Come on. Most of the mortgage holding American public refinanced their loan in 2020 and 2021 to a rate somewhere between 2 and 3.5%. If they sell that house, they're going to replace it with a mortgage at 6.5%. I've talked to a lot of people over the last year who have said they want to make a move, and once I run the numbers, they're like, John, that'd be ludicrous. I agree. So even though the number of buyers wanting to buy has dropped, the truth is the number of sellers wanting to sell has dropped as well. And there isn't new inventory being created because builders have significantly slowed down building. Builders cannot build a home and then put it in a warehouse waiting until the market is better. It'd be great if they could. We did it with toilet paper. We probably have billions of warehouses of toilet paper, so we never run out again. But you can't do that with a new home. So builders realized in 2022, rates are going up, buyers' interest is going down. I gotta slow down. And builders borrowed money, the smart ones, borrowed money back in 2020 and 2021 and stuck it in the bank. A lot of the large national builders have a huge war chest to live off of. They own a lot of land. They're right now making some deals to acquire some land and options, and I won't get into all of that, but the bottom line is they are not building. You cannot have a housing market crash if you don't have a whole bunch of people having to sell. And that's the key of why I don't think housing prices are going to drop significantly in 2023. I do see housing prices trickling down as they have been, and we're going to continue to see housing prices trickling down until we see interest rates probably in the 4s. I think by the time we hit interest rates in the 4s, we're now going to start having buyers say, you know what, maybe it is worth it for me to buy a house now. Maybe it is worth it for me to sell my house at 2.99 and get it at 4.5 because of a phenomenon called recency bias. So recency bias is something we dealt with in 2022. And it was, hey, I'm not going to buy a house right now because rates are at 6%. My buddy just got a house a year ago at 2.99. No way, I'm not going to do it. They were biased based on the most recent interest rates they had seen. The same thing happening is going to happen when interest rates drop to 4.5%, 4.9%, and they say, oh my gosh, that's a great interest rate because my buddy just bought a house and he had a 6.5% interest rate. The truth is all of those rates are really good in long-term historical perspective. A rate anywhere from 4 to 6% is a great rate. In the 1980s, rates were at 19%. But guess what? That wasn't very recent. And so the recency bias says, I don't know about that stuff, but I know that just a month or 2 or 6 ago, my buddy got a house at this interest rate. So when interest rates start coming down, buyers are going to want to buy again. Now, let me talk about buyers right now. There's 3 types of buyers today. They're the buyers who, and these are people who, I'm not even talking about homeowners that have a home to sell and buy. I'm talking about just renters, first-time home buyers. 3 types. The ones that can't afford to buy a home, the ones that won't make the payment based on today's interest rates, and then finally those that will are the only ones that A, can afford it, and B, are willing to spend today's interest spend at today's interest rates. But that's only 1/3 of the actual buying population. Once interest rates start coming back down, that first group that can't afford it, like, hey, my debt to income ratio is too high. When rates fall back down into the 4s, more of those people are going to be able to qualify, and they're going to fall into group number 3 that says, hey, I can and I will. Group number 2 is the wild card. Group number 2 is the buyers who are unwilling to spend that. Now, I think recency bias is going to say, oh my gosh, you quoted me a 6.5% interest rate 6 months ago, John, and now you're quoting me 5.25%. Well, that's a good rate. Now I'm willing to do it. I'm glad I waited. Man, I scored because I got a 1% lower rate than what he was quoting me 6 months ago. So I think a lot of those people will also move into the third category when interest rates drop. But the problem is there won't be more inventory. So let me be really, really clear on what I expect in 2023 for housing prices. I expect them to keep softening a little bit as interest rates stay in the sixes. As they hit into the fives and stabilize in the fives, I think we're going to see housing prices stabilize. Because I think that sellers are going to realize, hey, there's more buyers coming out of the woodwork. I don't need to lower my price. And the smart buyers are going to recognize I better jump now. Because as soon as interest rates get back into the fours, everybody else is going to jump into the market and house prices are going to go up. Now, is that going to happen in 2023? I don't know. But what I do know is it's likely to happen in 2023 based on everything that I'm seeing, based on the fact that we're likely to get into a recession, that it's going to push interest rates lower, and we've already seen inflation slow down. We don't have the same challenge with inflation that we did a year ago. So I believe we're going to see housing prices continue to soften until we get in the mid fives. We're going to see housing prices flatten out. But as soon as we get into the fours, I think we're going to see housing prices start to go up. And the reason why I think we're going to have challenges is because we're still not going to have new inventory. Now, I'm not even talking about new construction. I'm talking about just sellers willing to sell their home. There's a cycle. There's a circle of life, right? The Lion King. So the circle of life says, hey, you buy your first home, and then once you bought your first home, after a few years, you upgrade into your mid-sized home. And then once you get there, you've been there for 5 or 10 years, then you upgrade into a luxury home, and then you start downsizing. And at a certain point, you sell, and you're no longer a homeowner, and you're in a retirement home. You passed away. I mean, the circle of life, right? So the problem is that we, even at a 4.5% interest rate, there's still a bunch of people that have a 2.5% interest rate that say, I'm not interested. Especially in California, where your property taxes are tied to what you bought your home for. Now, there's some new rules that you can transfer your property taxes if you're over a certain age, but if you're not over that age, you can't transfer your property tax basis. So you lose your 2.5% interest rate, and you have to increase your property taxes significantly. So a lot of people who bought their starter home in 2019, that right now, 4 years later, it's about time for me to upgrade. We got 2 kids and we have a 2-bedroom home. We got to get a bigger home. I was talking to somebody this morning who has a 3-bedroom home, 3-bedroom, 4-bedroom home. So it's a 4-bedroom home, and he has 3 daughters, which is perfect because there's a bedroom for everybody, one for him and his wife, and then the 3 daughters each have a bedroom. Except his father-in-law just moved into their home. And he's run into some challenges, and he needs to move back into their home, he needs to move in with them. And so the father-in-law is now filling one of the bedrooms, and his 2 youngest daughters now have to share a bedroom. They have immediately, overnight, outgrown that home. But guess what? They have a 2.5% interest rate on their mortgage. Their property taxes, they bought their home 10, 12 years ago. Their property taxes are very, very low. They should, in a normal market, be a seller that lets that home go to somebody that needs that size home so that they can get the next size home. And it's not going to happen. We're going to be, I talked a few months ago about the freeze and how we're not going to have a crash, we're going to have a freeze. Well, guess what? Even when interest rates come down, we're still not going to have a lot of transactions because there's sellers that aren't going to sell. So even though the buyers now want to buy again, there's no homes for them to buy because the sellers don't want to sell. That's going to put even more pressure on housing prices to go up. Now, my biggest worry is we end up with the challenges we had in 2020 and 2021, where the only way you could get an offer accepted on a home is if you waived your contingencies, if you didn't look at the appraisal, if you didn't even get you had to get an appraisal, but you couldn't fight the appraised value. You had to pay over the asking price. that made it a very unhealthy housing market. And that's actually what the Federal Reserve has said was their biggest concern about where the housing market was at. They've solved that, but I don't know if they have. I think they just paused that. I think that our biggest challenge in 23 and 24 is the fact that we're not going to be freeing up homes, the starter home that person should be upgrading to, or the luxury home that somebody who's retired should be downsizing from. They're not going to do it. Why? Because that person downsizing won't save any money. If you owe $700,000 at 2.5% and you downsize to $500,000 at 5%, you didn't save any money in your monthly payment. So why move? There's going to be challenges in the markets. We're not going to see a crash. I think that for buyers, this makes now the best time to buy a home. Now, the challenge is if you're in category number one that I talked about earlier, which is that you don't qualify. Your income was enough to buy a house when rates were at 3, but your debt to income ratio is too high now. I'd consider looking for a co-signer. Try and get somebody that can help you out. Try and rent out a room or go together with your cousin and buy a house together and live together for a couple of years and split the mortgage payment, and you both go in it together to qualify, or your sister or your brother, aunt, uncle, father, mother, grandmother, grandchild. You get the point, okay? The point is find a way to qualify, because when interest rates go down, you can refinance. But when interest rates go down and you haven't bought, you're going to be in the challenge that I painted in the last few minutes, which is that you're going to be stuck because you're going to be, you'll get a lower rate, but you're going to be competing with a lot more buyers. The household formations are still there. The people that are coming of age and have come of age, they need a place to live. And yet there aren't going to be a lot of homes for sale. I don't expect to see a huge amount of inventory. That means we're going to see prices going up because supply is low, demand is high. We learned this in economics 101 in high school and college. When supply is low and demand is high, prices go up. So let me summarize a little bit here and kind of wrap up. Overall, I think that the economy is heading into a recession. I think that inflation is under control and it's going to be coming down. I think the Fed is going to continue to rattle their saber and tell you that, oh my gosh, it's a problem, because they're simply trying to finish the course of antibiotics, and they need to make sure that we don't go out and do something stupid while we're still on antibiotics. So the Fed's still going to tell you there's a big, big problem, but I don't think the problem is anywhere near as big. I think the problem is solved and we're just waiting for the course of antibiotics to be completed. I think that the housing market is strong, and that as interest rates come down, because recessions drive interest rates down, and as interest rates come down through this recession, we're going to see more buyers wanting to buy, but we're not going to see more sellers wanting to sell. A little bit more, but not the normal amount of sellers that you would normally see. So the market is going to struggle, and we're going to have to limp through it. But I think we have brighter days ahead. I feel like things are going to look better at the end of 2023 than they looked at the beginning. And so if you were thinking about buying a home, get prepared to buy now. The sooner you buy, I feel the better off you're going to be. If you're a realtor in the market, you need to make sure that you're talking about these things to your clients and helping them understand it. If you have questions, you want to talk to me one-on-one, I would love the opportunity to talk to you about where I think things are going and how I can help you make this happen. I appreciate you listening to me today. Please make sure to like, share, subscribe, send this to everybody that you know on every social media platform. And thank you for your trust in 2023. Please remember that I am not a nonprofit organization, so I live on helping people do mortgages. So if you know somebody that's looking to purchase a home, sell their current home and buy something else, or if they're looking to consider refinancing, one of the big refinance opportunities as rates start going down is everybody who took out a home equity line of credit or home equity loan. Because for the last year, that's been the best way to pull cash out of your home. But you need to get that consolidated at some point. So if you know somebody who took out a home equity loan or line of credit, give me a call and I can help you figure out at what interest rate does it make sense to refinance the home into one loan. Thanks so much for listening. Hope you all have a wonderful weekend, and we'll talk to you soon.